how to analyze SMB deals like an M&A pro. I want to show you how to identify bad deals in 5 minutes or less. So why are we doing this? I want to help you enhance your efficiency at deal analysis. The better you get at identifying bad deals and dumping them fast, the more time you get to spend on good deals. Let's go to another truth. Most aspiring business buyers often face the challenge of not having enough liquid cash to purchase the business outright. By using debt financing, you have the ability to acquire a much larger business than you might otherwise be able to afford with just your cash alone. Plus, debt also multiplies returns. So the question is, can we finance this deal? Is the deal eligible for SBA loan or not? You can't really tell if a deal is good or not from a broker's listing or the sim. So we want to run it through 5 financial tests. Do they use financial software? It's a yes or no. Most businesses use QuickBooks or FreshBooks or some sort of accounting system. If they don't, and they're using a Excel spreadsheet, you probably want to pass because you can make up these numbers pretty easily. If they do use a financial software, you need to ask for 3 to 5 years of income statements and 2 balance sheets, same date, 12 months apart. These are minimum. If you can ask for the cash flow statement, same date as close of income statement, 12 months apart, even better. That's the first test. Can't do that, pass on the business. Number 2, then you want to ask if they use cash or accrual accounting. If they use cash, that's likely trouble. Cash accounting only records transactions when actual cash changes hands. To my knowledge, there's only one type of business that uses cash accounting, and that's crack cocaine business. Accrual, on the other hand, accounting matches the cost of generating a sale with the actual sale in the same time period. If they're using cash accounting, the income statement is probably not going to be accurate, and you should pass on this. The third test is to check to see for profits and if the books are balanced. The books balance means the company's accounting records are in order, showing that all financial transactions have been properly recorded and reconciled. Specifically, this phrase refers to the balance between the company's assets, what it owes, and its liabilities and equity. What it owes and the owner's stake in the business. You can see on the income statement if they're making a profit or not. The income statement records the sales activities of a business along with the expenses incurred to produce those sales. If the sales exceed costs, there's a profit. If the cost exceeds sales, there's a loss. That is referred to as the bottom line. The key idea here is you cannot spend earnings, you can only spend cash. The bottom line or net income is only a theory of whether the sales did or did not exceed expenses. The balance sheet shows you the assets of the business, like cash, accounts receivable, and inventory, and then the assets you owe on money and the assets you own. If the books are balanced, then the earnings from the income statement will match the earnings on the balance sheet. The cash flow statement shows you how much cash you started with and the amount you added or used during that current period from operating, investing, and financing activities. If the books are balanced, the ending cash in the cash flow statement will match the cash on the balance sheet. If you have a green light so far, it looks like you have clean books. Clean books means accurate record keeping, transparency, a good sign that the business is ethical, which also means we have a higher confidence in its financial ability. We can go to the 4th test. If it doesn't have those, it doesn't mean you stop, but it means you may have to do a financial audit. Let's go to the 4th test. The 4th test is debt service coverage ratio. Debt service coverage ratio is the financial ratio used to assess the company's ability to pay its current obligations with its operating income. This ratio is commonly used by lenders and creditors to evaluate the likelihood that the business will be able to continue to cover its debt obligations. Debt service coverage ratio is calculated by taking the total debt service divided by the net operating income. We get the net operating income from the income statement. We get the total debt service from the balance sheet. And that's the total amount of current debt obligations. which includes the principal and interest payments for the company's loans and debts. You can figure out how much an SBA payments are going to be by using an S7A loan calculator. And there are many out there. I use this one here. Let's take a look at this deal. They're asking $2.22 million for the business, and we lever it up 90%, so it's $2 million. So at this current interest rate, 11.25, but I rounded up to 12% because of the fees, closing costs, and a 10-year return. You can see that the SBA loan payment of $28,694 and a total annual payments of $344,000. Most banks are going to mandate a 1.5 debt service coverage ratio. This implies that the business net operating income must be 50% greater than its total debt service. In other words, for every dollar of debt service, which includes principal and interest payments, the business earns $1.5 in net operating income. Let's take a lower debt service coverage ratio of 1.0. That means the net operating income is equal to its debt service obligations. This is a break-even scenario where the business can just barely cover its debt, but with no margin of error or unforeseen expenses. Now let's take a higher one. If the business has a debt service coverage ratio of 2.0, it means that for every dollar of debt payments, both interest and principal, it has to make in a given period, it generates $2 of operating income. A 2.0 is generally considered very strong. Anything higher, even better. It indicates the business is generating ample income to cover all its debt obligations twice over, which suggests strong financial health and a lower risk of default. This can be advantageous when seeking loans or credit for other projects, as lenders typically view a higher DS, debt service coverage ratio, as an indication of a lower risk investment. So the test is anything below a 1.5 is a pass because it's unfinanceable. Let's take an example where we know what the debt service coverage ratio is, and we need to figure out what the total debt service is. So we take equation, debt service coverage ratio equal net operating income divided by total debt service. We know what the debt service coverage ratio is, 1.5, and the net operating income is $1 million. We do a little algebra and we see that the total debt service is equal to the net operating income divided by the debt service coverage rate. $1 million divided by 1.5 equals $666,000. If the debt service coverage ratio is 1.5 and the net operating income is $1 million, then the total debt service would be approximately $666,000. This means that with a net operating income of $1 million, the business can afford annual debt payments of $666,000 while maintaining a debt service coverage ratio of 1.5. Anything below that, it's going to be a pass because you can't finance. All right, number 5, the last test, the multiples test. You ever wonder who really sets the selling price of a business? You may think it's the seller. In reality, banks play a pivotal role. Banks act as a guardrail in the world of business valuations. They can assess the value of business based upon its financial health and its future earnings potential. This assessment often determines the amount they're willing to lend for the purchase, essentially influence the selling price. So while sellers may have a price in mind, it's the banks that often have the final say in what the business is truly worth on the market. Let's take that example of the $2.22 million business again. At fair valuation and lever it up at 90%. At a $2 million, you can get a monthly payment of $28,694 or total annual payments of $344,000. What would it look like if the seller wants $3 million for it? Well, at $3 million price, you can see the SBA loan payment is $43,000 a month and a total annual payments of $516,000. At this point, you don't even need to do the math on this. You can make a quick call right in a second. You're not going to meet the 1.5 debt service coverage ratio. The deal is too expensive. You can't get financing on it. Here's the rule with buying companies with debt. Don't overpay. Warren Buffett would say, when the tide goes out, you can see who's not wearing shorts. Take this along with banks are not going to let you borrow at this valuation anyway, so don't waste your time on deals you can't get financing on. You're out there, you're looking for a business. You're in the business of buying cash flow at a fair price that you can get financing on. That's why I created this presentation. I want to show you how to enhance your efficiency in deal analysis, specifically in determining a deal's financeability. If you can do this fast, it's going to minimize the time you spend on unviable deals. This approach allows you to allocate more time and resources to exploring and capitalizing on promising opportunities. Essentially, the quicker you are identifying whether a deal is financially feasible or not, the more you can focus on nurturing and developing the deals that truly have potential. Thanks for watching.